Welcome to Level 2 Financial Reporting Analysis with me, John Bone. Now, we start off with two readings that are really drawing on our Level 1 knowledge. So some nice, easy intro to our financial reporting analysis for the Level 2 syllabus. Okay, so let's start off with inventories, implications for financial statements and ratios. Our first learning outcome asks us to both calculate and explain the implications for cost of goods sold and inventory of our cost flow methodology, so LIFO, FIFO, average cost. And again, we're meant to explain the implications of inflation in purchase prices and deflation in purchase prices. So first of all, let's start off with the cost of goods sold for a simple trading company, i.e. a company that buys in goods and sells them on. Well, in that situation, our cost of goods sold would be made up of our beginning inventory plus our purchases. Now that gives us the goods available for sale. Now, of course, we might not have sold all of those goods, so what we then do is deduct the ending inventory. The ending inventory is deducted, it's removed from the income statement and stored in the balance sheet. And of course, this year's ending inventory becomes next year's beginning inventory. So beginning inventory plus purchases, those are our items available for sale. And then what we're doing is deducting our ending inventory. Why? We're applying the matching concept. We're trying to match the total cost of the items in cost of goods sold to the number of items that we physically sold. In other words, if you've sold 100 items, then we want 100 items in cost of goods sold. So let's imagine with that 100 items sold, so we've sold 100 items, sold 100 items. So let's imagine my beginning inventory was 20 units, I purchased a further 120, so my available for sale represents 140. My ending inventory, therefore, is 40 items being removed, taken to the balance sheet, so that my cost of goods sold represents the 100 items. In other words, I'm matching the number of units in my cost of goods sold to the number of units actually sold. Now, of course, the cost flow methodology is how I attach the cost to those 40 items, i.e. FIFO, LIFO, AVCO, and specific ID. So let's have a look at our cost flow methodology. FIFO, now of course FIFO stands for first in, first out. The first goods that entered your warehouse were the first goods that you sold. In other words, you've sold the oldest items first. Now of course what that means is your ending inventory must be made up of the most recent purchases. So we're going to value the ending inventory using the most recent purchase prices. Now, again, assuming we live in an inflationary environment, and notice our little star up here means we are assuming rising purchase prices over the period and either constant or increasing inventory levels. Key one though here is rising prices. Okay, now, of course, if we've got rising prices, it means the purchases towards the year end would have been at the higher price. So therefore, if under FIFO we value our ending inventory using the year-end purchase prices, we're going to end up with the highest value for our ending inventory. Now, whatever gives you the highest value for ending inventory is going to give you the lowest value for cost of goods sold. Remember on the previous slide, we said beginning inventory plus purchases minus our ending inventory gives us our cost of goods sold. So high ending inventory means low cost of goods sold. Now LIFO, now again we've said not under IFRS, so LIFO is allowed under US GAAP but not under International Financial Reporting Standards. Here we assume that we've sold the most recent items first and therefore our ending inventory is made up of the oldest purchase prices. Now again, assuming we're living in an inflationary environment, those old purchase prices are now very much out of date and low. So we get the lowest value for our ending inventory. And of course, lower value for your ending inventory, higher value for your cost of goods sold. Now AVCO says, no idea really whether I've sold old or new items, so I'm going to value at the average price during the year. So we take our beginning inventory plus our purchases to get the available for sale value. We then divide that by the number of units it represents to get an average price per unit. We then value both the cost of goods sold and the ending inventory at that average price. Now, by definition, because it's using an average price, both ending inventory and cost of goods sold should be somewhere between the LIFO and FIFO results. Specific ID, this is typically used for very high value items. Let's imagine I'm a diamond merchant. Now, towards the year end, I've got 5 diamonds left in my ending inventory, let's say. Now, I'm not going to use the average price I bought diamonds at in the year, or I'm not going to use the price that I bought the last diamonds for in the year. I want to attach the actual price I paid for each of these 5 diamonds. And that's what we're doing with specific ID. Now, be aware there are 2 systems, periodic systems, which tend to be smaller companies, and perpetual systems, which tend to be larger companies. Now, with a periodic system, all that's going to happen is every time we buy goods into the company, they're going to go into a purchases account located in the income statement. It's then only at the end of each period that I'm going to total up the number of items I haven't sold, value those items, and remove them from the income statement and store them in the balance sheet. In other words, we only discover our cost of goods sold, or we only calculate our cost of goods sold at the end of a period. Until then, we've only got a purchases account in our income statement. Okay, so inventory and cost of goods sold determined at the end of the period under a periodic system. And as I said, that tends to be smaller companies. Now, if you're a larger company with a lot of inventory, you're going to want to keep tabs on that inventory. So you're not going to wait until the end of each period to count up what you've got left and then value it. Instead, what you're going to want is a computerized system that monitors your inventory every time you make a purchase or a sale. And that's exactly what's happening with our perpetual system. Now, every time we make a purchase, rather than going into a purchases account in the income statement, it's going directly into inventory in the balance sheet. Okay, so our inventory is increasing every time we make a purchase. Cost of goods sold is going to update every time we make a sale. So every time we make a sale, we're going to reduce inventory in the balance sheet and transfer that cost into cost of goods sold in the income statement. So you've got your cost of goods sold and inventory levels updating on a real-time basis every time a purchase and a sale are made. Okay, now, do these methods affect FIFO, LIFO and AVCO? The answer is, if you're using FIFO, whether you use a periodic or a perpetual system, you get the same ending inventory, you get the same cost of goods sold figure. However, if you're using LIFO or average cost, that is not the case. We're going to see that there are distortions caused by the method that you use. Okay, so just be a little bit aware of that. Again, I don't think you'll be calculating or comparing periodic to perpetual, but you might need to know, oh look, it does have a difference. So let's have a little look at some examples, make it nice and straightforward for us here. And we're going to look at the 2 methods. So we're going to use the following to calculate costs of goods sold and ending inventory under both FIFO and LIFO for the month of March. So notice we've got here 4 units that we had in beginning inventory valued at $3 per unit, so a total of $12 of beginning inventory. We then sold 3 units on the 14th of March. Okay, we've then got a purchase of 10 units, and then we've sold a further 8 units on the 28th of March. So let's just work out our total ending inventory here. So you've got the 4 units that you purchased plus the, 4 units of beginning inventory, I should say, plus the 10 units that you purchased, giving 14 units. That's the total amount available for sale. How many did we actually sell? 3 and 8. So we sold 11 units. So let's deduct those 11 units sold. And actually, we're trying to value 3 units here. So our ending inventory is going to comprise of 3 units. Now let's have a look at FIFO under the periodic approach first, and then under the perpetual. Now, of course, you have your beginning inventory, 4 units at $3 each, so that's 12. You've then got your 10 purchases made at $3.70, so that's $37. And of course, beginning inventory plus purchases gives us our available for sale. So our available for sale value would be $49 there, essentially. Then we've got to value our ending inventory. Now remember, under FIFO, we're going to make the assumption that the ending inventory is the most recent purchase prices. In other words, those 3 units we haven't sold came from the 10 units of purchases that we made on the 25th of March. So in other words, we're going to value them at $3.70 each. So 3 units at $3.70, that gives us ending inventory of $11.10. Let's total up our cost of goods sold. So beginning inventory 12 plus purchases 37, taking us to 49, less ending inventory of 11.10, bringing us down to 37.90. Now let's have a look at the perpetual method. Now remember, nothing is going into cost of goods sold until we make a sale. So at the beginning of the year, sitting in our inventory in the balance sheet, we're going to have those 4 units at $3. We then make a sale on the 14th of March. Now that has to be out of the beginning inventory because we don't have any other inventory at that point. So we're going to record this sale of 3 units on the 14th of March using the beginning inventory. So we're valuing 3 units at $3. And that gives us the cost of goods sold for those 3 units of $9. Now then, we make a purchase on the 25th of March of 10 units. So our ending inventory has now gone up to 11 units at this stage. 1 unit remains of the beginning inventory at $3, and we've got 10 units currently of the new inventory at $3.70. Now when we make the 28th of March sale, we're assuming we sell 8 units. Now 1 unit is going to be the oldest purchases, the beginning inventory, so 1 unit at $3. The remaining 7 units, of course, are coming from our purchases made on the 25th of March at $3.70. So 1 unit from the beginning inventory, and of course that's eliminated all our beginning inventory now, 7 units at $3.70. Now notice what you see straight away is that the cost of goods sold under the 2 methods, perpetual and periodic, is identical. It makes no difference. And look at our ending inventory. Of course, our ending inventory must come from those 10 units that we purchased on the 25th of March. We've only got 3 units remaining, and we valued them at the most recent purchase price under FIFO, so 11.10. So again, notice that these 2 values are identical as well. So FIFO under a periodic or a perpetual method makes no difference at all. Now let's have a look at LIFO. LIFO is going to have a difference here. Now, of course, let's start off with periodic. Beginning inventory, 4 units at $3, so that's 12. Purchases, 10 units at $3.70, 37. Now, our ending inventory. The assumption here is that we've sold the most recent items. In other words, what we're going to do is make an assumption here that we've actually, in our units sold, which was a total of 11 units, 10 of those will be at $3.70, 1 of them will be at $3. What that means, of course, is that our ending inventory comprises of the oldest purchases, 3 units of beginning inventory. So we're going to value it at 3 units at $3, giving us a value of 9. So 12 plus 37, giving us 49, deduct the ending inventory of 9, and that brings us down to 40. Now let's have a look at a perpetual system. Okay, so we've got, at the start of the year, our 4 units sitting in ending inventory in the balance sheet, valued at $3 each. First thing that happens in the month is we make 3 units of sales. That has to come out of our beginning inventory because we don't have any other inventory at this point. So notice on the 14th of March, the costs for those sales are going to be 3 units at $3. Now, of course, what that means is we've now got 1 unit left at $3. Then on the 25th of March, we make our purchases, 10 units at $3.70. So we've now got beginning inventory, 1 unit at $3, 10 units at $3.70. We now make our sale of 8 units. Now remember, under LIFO, last in, first out, we assume that these sales come from the most recent items. So we're going to value those 8 units at $3.70, giving us a cost of goods sold of $38.60. So again, straight away, notice we've got a difference in our cost of goods sold. Now, of course, by definition, if we've got a difference in our cost of goods sold, we must have a difference in our ending inventory. Under LIFO, we've got 1 unit of the beginning inventory remaining. There it is. And of course, we must have 2 units of the purchases that were made on the 25th of March. So 2 units at $3.70, giving us an ending inventory of $10.40. So notice the periodic method gave us $9, and of course the perpetual system gave us $10.40. So we are picking up now on differences under the between the periodic and perpetual when we look at LIFO. And again, of course, you'd see differences under AVCO as well. So here's really our summary. Again, FIFO, you're meant to be saying, well, look, no differences under FIFO. But when we look at LIFO, of course, hey, look, there are differences. And AVCO, of course, as well, would pick up on differences. Okay, so FIFO and specific ID are unaffected by the method that you use. LIFO and AVCO are affected by perpetual versus periodic. Now, of course, we're asked to talk about how prices rising affect our methods. So let's have a look at inventory valuation and price changes. So first of all, we're looking at purchase prices rising, i.e. an inflationary environment. Now, in this situation, FIFO gives you an artificially low value of cost of goods sold. That's because FIFO, under FIFO, in your cost of goods sold, it contains all of the older purchase prices. The more recent purchase prices, of course, are contained in your ending inventory. So you get a very low value of cost of goods sold. Okay, now the argument would be that essentially the cost of goods sold doesn't represent the economic cost to the company. So in other words, LIFO would be more useful. If you were to use LIFO for your cost of goods sold, then your cost of goods sold would contain the more recent purchase prices. So they would be closer to the true economic cost of the company. So up short is what we're saying is we kind of like LIFO in the income statement. Now, if we were to use LIFO in the balance sheet, we would have a problem though, because when you use LIFO, you're valuing your ending inventory at the oldest purchase prices. In other words, LIFO gives you an artificially low value for your ending inventory. In other words, ending inventory now is no longer close to the true economic value of the ending inventory. And when I say economic value of the ending inventory, I'm really talking about, if you like, the cost to replace it. So FIFO would be better. If we used FIFO in the balance sheet, then our ending inventory would be closer to the true cost of actually replacing that ending inventory. Okay, so you can see we've got a bit of a conflict here. Essentially, what the analyst would rather like to do is see FIFO in the balance sheet, but LIFO in the income statement. And of course, you've either got one or other. Okay, so essentially when prices are rising, LIFO gives you the highest cost of goods sold and the lowest ending inventory. Now, of course, when prices are declining, the opposite would be true. Okay, and of course with stable prices, no matter what method you use, you get the same ending inventory, you get the same cost of goods sold figure. Okay, let's have a look at an inflationary environment once more and the impact on those financial statements. So, in the income statement, let's again look at our income statement first of all. We've got our cost of goods sold, our EBIT, our taxes, and our net income. So, higher versus lower. Now, of course, we haven't told you which column here is LIFO, which column is FIFO. Let's have a think about working it out. Of course, in an inflationary environment, your ending inventory is valued at the highest figure. And of course, if you have higher ending inventory, then you're going to have lower cost of goods sold. So that means, essentially, this column here must be our FIFO, and this column here must be our LIFO. So, again, remember your cost of goods sold. Just think simple trading companies. In other words, beginning inventory plus your purchases less your ending inventory. In an inflationary world, FIFO gives you the higher ending inventory and therefore gives you the lower cost of goods sold. The opposite is true, of course, for LIFO. LIFO would give you a lower ending inventory and therefore a higher cost of goods sold. Now, a lower cost of goods sold, of course, gives you higher earnings before tax. Well, it gives you a higher gross profit. It gives you higher earnings before tax. Implication on taxes. Important thing to remember, especially under US GAAP, whichever method you use in the accounts, in other words, whichever cost flow method you use in your accounts, you must also use in your tax returns. So if I choose to use FIFO in my accounts, I've got to use it in my tax returns. Now, given FIFO gives me a higher earnings before tax, it must mean that I also have to pay more tax as well. Compared to LIFO, lower earnings before tax, you pay less tax. So bad news under FIFO in an inflationary environment, it will result in you paying higher taxes. Flip side is you also get to report higher earnings, of course. Now let's turn our attention to the balance sheet. Where does our ending inventory end up? Of course, we're removing the ending inventory from the income statement and transferring it to the balance sheet. So under FIFO, you're going to have a higher ending inventory figure because it contains the most recent purchase prices and of course they've inflated over the year. Working capital, again you can view that really as current assets minus current liabilities. Lots of different definitions. When you talk about cash flow statements and you're calculating CFO under the indirect method, they're talking about non-cash working capital. In other words, current assets excluding investments in cash, current liabilities excluding debt instruments and dividends payable. Here, our basic definition is simply total current assets minus total current liabilities. Okay, now of course, no implications at all for current liabilities, but it is under current assets because inventory is a component, and of course FIFO, if you've got higher inventory, you've got higher current assets, you've got higher working capital. RE stands for retained earnings, a component of stockholders' equity. Remember, every year we generate that year's earnings, we pay out a dividend, and anything left gets added to retained earnings. So retained earnings represents the cumulative amounts that we could have distributed in prior years but decided to retain within the company. Now, of course, there's a direct link between the income statement and the balance sheet via retained earnings. Anything that affects net income gives you higher retained earnings. So if your net income is higher under FIFO, your retained earnings in the balance sheet and therefore stockholders' equity in the balance sheet will be higher under FIFO. CFO, now cash flow from operations or operating cash flows, don't let them trick you in the exam, means the same thing. Operating cash flows, cash flow from operations, use them interchangeably. Now CFO would be the same if it wasn't for the taxes. Okay, now taxes, of course, are going to lead to cash outflows when you pay those taxes. So because your tax is higher under FIFO, your tax bill is higher, tax passes out through cash flow from operations, giving you a lower CFO, but only because of the tax implications. If it wasn't for tax, then we'd be saying same with our cash flow statements. Now, our next little learning outcome here says explain LIFO reserves and LIFO liquidations. We're going to talk about LIFO reserves here. We're going to see LIFO liquidations in a few slides' time. So LIFO reserve, if you're a company, a US company, and you've adopted LIFO, then you have to report the LIFO reserve. Why would a US company adopt LIFO? Surely we live in an inflationary world, well, at least most of the time, and therefore adopting FIFO would give you higher earnings. Well, true, but it also gives you higher tax bills. So what you often find is companies, US companies, will choose LIFO to minimize their tax liabilities. Now remember, LIFO is effectively banned under IFRS, so you're not going to see it. It's not an issue for IFRS-led companies. But certainly it is for US-led companies. Now, if you are a company using LIFO in the US, then you have to disclose the LIFO reserve in your footnotes. And the LIFO reserve is simply the difference in your ending inventory valued under LIFO and valued under FIFO. Okay, so there it is. It's going to be sitting in the footnotes. Now that's good news for the analyst. What it means is we've got some of the information that we need to be able to adjust accounts from LIFO into FIFO. Okay, so that's what we're going to do. We're going to adjust balance sheet ending inventory if we want to adjust from LIFO to FIFO. Now the LIFO effect, it says down here, the LIFO effect, it's the change in the LIFO reserve from one period to the next that actually affects our cost of goods sold. Well, yes, because if you think about our cost of goods sold, it's made up of beginning inventory plus our purchases less our ending inventory. So there's our three components. That gives us our COGS, cost of goods sold. Now, of course, it's going to be the opening reserve, opening LIFO reserve that affects beginning inventory. Nothing affects purchases, we can leave that. And the closing reserve that affects ending inventory. Notice we're adding beginning inventory but subtracting closing ending inventory. So after we've made our adjustment, let's call this LIFO, let's call this FIFO. Beginning inventory is higher by the opening LIFO reserve, purchases unaffected. Ending inventory is going to be higher by the closing LIFO reserve, giving us our cost of goods sold. What that means essentially is, look, cost of goods sold will have essentially changed by the change in the LIFO reserve. Oops. So in other words, if the LIFO reserve is increased, opening LIFO reserve is smaller than closing LIFO reserve, subtract that change. Again, we're going to see that with some numbers in a while to make that illustration a bit clearer. Okay, our next LOS asks us to convert the financial statements from LIFO to FIFO. Inventory, very, very straightforward. All we do is we take the inventory under LIFO and we add on that LIFO reserve. Let's say the LIFO reserve is 10,000. We take LIFO ending inventory, add 10,000 to it. Hey, we've now got FIFO ending inventory. Now, of course, you can't just increase your assets by 10,000. The balance sheet wouldn't balance. So there are some more adjustments. And in fact, we're going to have to make adjustments to cash and equity. What we're going to do is adjust our cash balances down. The argument that we're going to put forward here is that if we switch to FIFO, in the income statement, and again we're assuming an inflationary world here, in the income statement our profits would be higher, and if our profits were higher we would pay more tax and we'd have less cash. So we're going to take cash under LIFO, we're then going to take the LIFO reserve times the firm's tax rate. And this, if you like, this component element here would be the additional tax paid. And I think that's conceptually the trickiest area of this adjustment. I think the balance sheet adjustments are harder than the income statement adjustments, specifically because of this point. Now, what we're saying therefore is inventory has gone up, cash has gone down, and equity is going to have to change by the balance just simply to keep the financial statements balancing. So it's going to change by the LIFO reserve times 1 minus tax. Now the income statement is a little bit more straightforward. We're going to take our LIFO cost of goods sold and subtract the change in the LIFO reserve. Remember, by subtracting the change in the LIFO reserve, what essentially we're doing is we're adding last year's LIFO reserve to beginning inventory, and we're adding this year's LIFO reserve to ending inventory. So notice cost of goods sold under FIFO are going to be lower than cost of goods sold under LIFO, again assuming inflation in your purchase prices. Now, impact on taxes this year, of course, well, we're going to pay more tax because our profits are going to be higher because our costs of goods sold are going to be lower. So we take our LIFO taxes and then we add on this additional tax. Our profits are going to be higher, our profit before tax is higher by the change in the LIFO reserve. So take the change in the LIFO reserve times the firm's tax rate. And that's the additional tax we're paying on this year's profit. Then finally, net income under FIFO. Let's take the LIFO net income. Of course, profit before tax is increased by the LIFO reserve, so profit after tax must have increased by the LIFO reserve times 1 minus T, where T is our tax rate. Okay, and we'll see a numerical example of this in the class. LIFO to FIFO adjustments on our ratios. Of course, we're asked to not only be able to convert the financial statements, but then actually also discuss how LIFO and FIFO affect the financial statements and the ratios that we calculate. We're asked to analyze and compare in this learning outcome. Okay, so LIFO to FIFO adjustments, if we make these adjustments, notice we're saying an increase in the current ratio. Now, of course, our current ratio is current assets over current liabilities. Now, of course, what we're saying is our current assets are going to increase. Inventory, of course, is going up by the LIFO, closing LIFO reserve. But, of course, remember, cash is going down by the increased tax paid. Overall, though, our current assets are going to rise, essentially. So we've got higher current assets, current liabilities unaffected, and therefore, of course, our ratio is going to improve. Now, remember, a current ratio is essentially a liquidity-based ratio. Let's look at some other liquidity and efficiency ratios. So inventory turnover is our next one to look at. So we've got cost of goods sold over average inventory. Now, of course, if we're going to use our FIFO methodology, that's going to increase our average inventory. Again, assuming an inflationary environment, of course. What's the impact on cost of goods sold? Well, remember our cost of goods sold. Again, go back to a basic trading company. Beginning inventory plus purchases less ending inventory. If we've got higher inventory, we're overall going to have lower costs of goods sold. Okay, so our cost of goods sold is going to go down a little bit. In fact, it falls by the change in the LIFO reserve, remember. So lower cost of goods sold, higher average inventory, and therefore overall our inventory turnover, of course, is going to decline. Debt to equity, so debt being all of our interest-bearing liabilities, total debt, both long-term and current liabilities, over equity being our stockholders' funds, the bottom half of the balance sheet. Okay, so long-term debt to equity, well, of course, there's no implication on debt when you change the valuation of your inventory. You're talking inventory is an asset, not a liability. So debt remains unchanged. So our debt remains static. However, if we switch from LIFO to FIFO in an inflationary environment, our net income is going to be higher. And remember, it's going to be higher by the change in the LIFO reserve times 1 minus tax. And if our net income is higher, our retained earnings are higher. And of course, retained earnings are a component of your stockholders' equity. So your equity is going to increase a little bit, and therefore, overall, your debt to equity ratio is going to decline. Gross profit and net profit. Well, gross profit, of course, is sales minus your cost of goods sold over your sales. Now, your inventory valuation method doesn't affect the sales figure, but of course it does affect the cost of goods sold. Now remember, we said essentially under FIFO your cost of goods sold will be lower by the change in the LIFO reserve essentially. So we're getting a lower cost of goods sold figure, so a higher gross profit. So overall our numerator will be higher, our sales unaffected, so therefore we've got a higher gross profit margin. Of course, net income over sales is our net profit margin. Again, sales figure unaffected, but remember the net income is going to increase by the change in the LIFO reserve. So change in reserve, remember, times 1 minus tax. So our net income is increased, so again, our profit margins are going to be improved. Now, LIFO liquidation, returning to an earlier learning outcome that asked us to explain a LIFO liquidation. Now, first of all, what is it not? It's not anything to do with the company being liquidated. It's not to do with insolvency. What it is to do with is a company that has used LIFO year after year and then suddenly reduces its ending inventory levels. Now, the impact of suddenly reducing the ending inventory levels is to release all of these very, very old costs that have been stored in ending inventory, releases them back through cost of goods sold. So it gives you a very, very low figure for cost of goods sold if you reduce your inventory levels. Okay, so let's have a look at it. A LIFO liquidation occurs when goods sold exceed goods replaced. In other words, we've got decreasing inventory levels. Now, as we said, because inventory has been valued at old purchase prices under LIFO, this releases those old purchase prices through the cost of goods sold. So our cost of goods sold now contains very old and out-of-date prices. Old and hence low prices. So we get an artificially low cost of goods sold figure in the year in which we sell off this inventory. And of course that boosts our gross profit, it boosts our earnings. The key though is, look, this is not sustainable, it's a one-off boost. We've created this by selling off our ending inventory and releasing these old costs. Yes, it will boost, of course, earnings in the period in which we do that, but it's a one-off boost. It's not going to be repeated going forward. In other words, it's rather a cosmetic boost to our earnings. We should be aware of this as an analyst. Now, of course, it could be intentional, of earnings manipulation, or it could be involuntary. Stock levels have had to decline because that's the only way that they could have made or met customer demand. Maybe strikes and recessions have reduced the amounts of goods they can produce, essentially. Okay. Fair enough. But the key point is it's boosted, it's distorted our profit margins in the year of the LIFO liquidation. What should the analyst do? Well, eliminate the impact of the LIFO liquidation by adjusting cost of goods sold. In other words, let's adjust cost of goods sold from LIFO to FIFO. Amount disclosed in the footnotes, well, of course it is. We know we need to adjust by the change in the LIFO reserve. Now, we then turn on our attention to the rules lower of cost and net realizable value under IFRS, lower of cost and market value under US GAAP. And we're asked to describe the implications of using net realizable value to value inventory in the balance sheet and income statement. Okay, so IFRS says the lower of cost and net realizable value. Now, the definition of cost is pretty much the same under both US GAAP and IFRS. Essentially, both of them say we can include all of the standard costs of bringing the inventory into its current location and finished condition. Okay, it's all the standardized costs. So in other words, we're going to ignore any abnormal amounts, abnormal labor, abnormal material uses. It's the standard cost of producing your goods essentially here. Storage costs for raw materials could be included, but storage costs for finished goods, no, they cannot be included. Why? Because it's only to get the stock into its current location and finished condition. Once the goods are finished, any additional costs can't be included. Admin overheads, they're going to be excluded as well. Why? Because they have nothing to do with the production process. So if we're a manufacturing firm, we are going to include production overheads in the cost of our inventory, but not any admin overheads, nothing that is not directly related to the production process. And then finally, the cost of selling your finished goods. No, again, we can only include the cost, the standard cost of producing our goods and getting them into their current location. Any additional costs we incur in actually selling those finished goods has to be excluded. And in fact, under US GAAP, our non-cost of goods sold are actually defined as sales, general and admin, the operating costs that you incur in the day-to-day running of your business that are not directly related to the production process. Okay, so look, key point here is the standard cost of producing an item. Now, IFRS then gets us to compare that to NRV, net realizable value. Now, net realizable value, the estimated selling price less any estimated selling cost. That's typically it. Here's what I think I can sell it for. Oh, here's the additional costs I'm going to involve in selling it. That gives me NRV. Now, if you're looking at work in progress, there's an extra line that we need to worry about, and that's the estimated cost of completion. When we come to value inventory, there are three real classifications of inventory: components and raw materials, work in progress, and finished goods. Now, work in progress are goods that we've started to complete during the year but haven't completed them at the year-end balance sheet date. So their costs over here will only represent the costs we've incurred to date. So when we look at net realizable value, we look at the selling price of a finished good, but we need to deduct the costs to get our work in progress into finished condition. Okay, but for finished goods, it's just going to be estimated selling price less estimated selling costs. Now, if net realizable value has declined below cost, you have a write-down. You have to write down the value in the balance sheet, and that other side of that write-down goes as an expense, an unusual or infrequent item, so before the tax line, into the income statement. Now, IFRS does allow you to reverse write-downs. US GAAP typically doesn't. And we're going to see this all the way through. Basic rules for impairments and write-downs is IFRS normally allows you to reverse. There are some exceptions. Goodwill and equity accounted investments spring into mind. But IFRS normally allows you to reverse write-downs and impairments. US GAAP normally doesn't. Again, I will point out the exceptions to this rule as we go through. So here is US GAAP. Now notice US GAAP compares cost not to net realizable value, but to market value. So we need to define what this market value is. Well, market value is the replacement cost, the cost of the firm of replacing these items. Now, it's replacement cost, but it is subject to an upper and a lower limit. The upper limit is net realizable value. The lower limit is net realizable value minus normal profit margin. So as long as replacement cost is in that range, between those upper and lower values, you use replacement cost. If replacement cost goes above net realizable value, you use net realizable value. If replacement cost falls below net realizable value minus normal profit margin, then you use NRV minus normal profit margin. Does make the rules a little bit more complicated under US GAAP. Now again, the write down though is the same. You write down the inventory value to essentially market value if market value is declined below cost, and the other side of this goes to unusual or infrequent items in the income statement as an expense. Now note, there's the rule that we said. US GAAP does not allow you to reverse write downs. It's prohibited. Why? Well, US GAAP is much more worried about earnings management, especially given the big accounting scandals that have been witnessed in the US, you know, the Enrons, the Sunbeams of this world. So they don't like write-downs essentially to be reversed. They're worried about them being used for earnings management. In other words, if I created a write-down or impairment in the current period, this year's income takes a hit, this year's earnings take a hit. But then, if I reverse it in the subsequent year, I boost the earnings in the subsequent year. So essentially, creating an impairment and then reversing it, or creating a write-down and then reversing it, just takes some profit out of this year and moves it into the following year. So it can be used to shift profits between years. US GAAP doesn't like that idea and therefore essentially prohibits it. IFRS is much more about economic substance, and therefore it believes if the true economic substance is that there has been a recovery in net realizable value, then it wants you to be able to reflect this, even though, on the flip side, it could be used for earnings management. Okay, so let's have a look at IFRS and US GAAP reporting inventory above cost. I really wouldn't lose a lot of sleep on above cost. Be aware that it's really in the commodities world. If you're a commodity producer or a dealer of commodities, then you can elect essentially to record your commodities at fair value rather than historic cost essentially. So look, we report in the balance sheet at net realizable value. So fair value goes into the balance sheet rather than cost. Now, notice we use quoted market price if there's an actively traded market. Otherwise, we'll have to simply use recent market transactions. So typically, we're going to use year-end market price to value the commodities. Now, of course, what that means is we're going to generate unrealized gains and losses. And we're going to see this on investments that are treated very similar a little bit later, our trading securities. Now, if we've got unrealized gains and losses, where do these unrealized gains and losses go? In other words, let's imagine fair value is increased for our commodity, our inventory in the balance sheet. You increase the value of the inventory in the balance sheet. You can't just increase inventory. The unrealized gain or loss has got to go somewhere else. Answer is, it's the income statement. Okay. What does unrealized mean? This phrase unrealized, it simply means on inventory that we haven't sold at the year end. Okay, and it's caused by these fair market value adjustments. So we're going to take them direct to the income statement. Okay, it's really only for commodities. It's really pretty rare, so I wouldn't get too concerned for the exam. Now, analyze and compare financial statements and ratios, of course. Looking at our inventory methods is our learning outcome. So let's have a look. Compared to FIFO, LIFO is a better measure of economic cost. Where? Well, in the income statement, of course. Because if you use LIFO in your income statement, the cost of goods sold contains the most recent purchase prices. And therefore, it's closer to the true economic value of the items sold. So we like, as we said, LIFO in the income statement. If, again, we've got an inflationary environment, if we use LIFO, which we do prefer, of course, we get a higher cost of goods sold figure. Why? Because our ending inventory will essentially be lower. Remember, under LIFO, the ending inventory is going to contain the oldest purchase prices. So we get a higher cost of goods sold figure. That's going to give us, therefore, lower gross profit and therefore lower operating profit and lower net profit margins. Lower margins. Argument is, therefore, LIFO would be a bit more prudent. Remember, anything that really kind of boosts your earnings is deemed to be aggressive. Anything that makes your earnings smaller is deemed to be conservative or more prudent. So LIFO is certainly a more prudent policy to adopt in the income statement in an inflationary environment. What about our liquidity ratios? Liquidity ratios, of course, are looking at the ability to really pay off our short-term liabilities as they fall due. We look at liquidity and we look at solvency ratios. Liquidity ratios, ability to pay off short-term liabilities. Solvency ratios, ability to pay off long-term liabilities, i.e. a capital structure. Okay, so let's have a look. FIFO, we prefer FIFO in our balance sheet. Why? Well, it means that the ending inventory is at the most recent purchase prices and therefore closer to the true replacement cost of your ending inventory. So prefer FIFO in the balance sheet. FIFO will give you higher ending inventory balances. It will give you, therefore, a higher current ratio, current assets over current liabilities. If it gives you higher inventory, you have higher current assets. You get, therefore, a higher ratio. Current liabilities, of course, unaffected, and higher working capital, current assets minus current liabilities. Fine. LIFO cost of goods sold is based on recent prices. Yes, we've said this already. Most recent purchase prices included in cost of goods sold if you're using LIFO. LIFO ending inventory, though, is based on historic out-of-date prices. Yes, the older purchase prices go to into ending inventory under LIFO. So assuming inflation, LIFO gives you a higher inventory turnover because you get a higher numerator. Remember, if ending inventory is lower in an inflationary environment under LIFO, ending inventory is lower, so essentially you're going to get a higher cost of goods sold figure. And of course, if your ending inventory is lower under LIFO, you get a lower average inventory figure, and therefore overall your inventory turnover is going to increase. Now, days of inventory on hand is 365 divided by inventory turnover. Let us remind you of what days of inventory on hand represents. It's the length of time between receiving raw materials, starting the production process, finishing the production process, and selling your finished goods. So in other words, the length of time between receiving raw materials and selling finished goods is our days of inventory on hand. Now, 365 divided by inventory turnover, so the higher inventory turnover is, the lower the days of inventory on hand is. So, as we said, LIFO gives you a higher inventory turnover, so it must give you lower days of inventory on hand. Now let's turn to our leverage ratios, really our solvency ratios, looking at our debt to equity levels. Now, of course, again, assuming inflation, FIFO results in higher assets. If you've got higher ending inventory in your assets, then we're going to have higher stockholders' equity as well. Remember, we said earlier when we were looking at adjusting LIFO into FIFO, we said actually what we'd do is we'd increase ending inventory, we would reduce cash because of the additional taxes paid, and increase equity by the net amount. So we are going to see higher equity under essentially under FIFO. So we get higher equity under FIFO. Higher net income, and of course lower cost of goods sold. But that's why we have higher net income. Remember, cost of goods sold under FIFO is lower by the change in the LIFO reserve. Okay, so let's have a look at what will happen to debt to assets. So essentially total debt over assets. Well, again, no impact really on the total debt. But the assets, of course, are going to be higher because ending inventory is higher, even though that's partially offset by paying more tax. So essentially, therefore, we're going to get a lower debt to asset ratio. Debt to equity, again, total debt over stockholders' equity, total debt unaffected, but of course, net income is higher in the income statement. Net income is higher by the change in the LIFO reserve times 1 minus tax. And if net income is higher, retained earnings are going to be higher under FIFO. So we get a higher equity figure and therefore lower leverage if we use FIFO in an inflationary environment. Okay, so we're moving towards the end of our reading now. Our last learning outcome asks us to explain issues analysts should consider. So first of all, we can see an increase in raw materials and an increase in work in progress. How should we interpret this as an analyst? Well, there's no rule about how we should interpret everything, but one thing it could indicate, and of course further investigation would be required, is potential increased demand for finished goods. Why are we holding more raw materials? Why are we midway through producing more finished goods? Hey, well, we must be thinking that we need more finished goods in order to sell. In other words, demand for finished goods will rise. An increase in only your finished goods. So your finished goods have gone up, but raw materials and work in progress haven't. Could be an indication of decrease in demand for finished goods. In other words, essentially the reason our finished goods have gone up is because we can't sell them. Now again, that would indicate that maybe we need to be considering potential write-downs as well. Maybe there are write-downs that haven't been recorded in the financial statements. Finished goods that are growing faster than sales, well again, a worry. Why are our finished goods increasing faster than sales? Again, could be due to decreases in demand, and again, it could be that there are essentially, we've got obsolete inventory that we haven't yet written down in the financial statements. So again, it may be an indication that write-downs are required. Okay, so the key to the exam, I think, of all the things here, I would be aware of how to adjust a set of accounts from LIFO into FIFO. I think that's going to be your biggest one. Also, of course, always taking it back to the ratio analysis. How does LIFO versus FIFO actually affect the ratios that we compute? Could we be asked to calculate ending inventory under LIFO and FIFO? Yes, I think potentially we could. It's certainly possible. Probably, I would imagine, periodic more likely to be tested than perpetual. But certainly the LIFO to FIFO adjustment, that's the area that I would like you to really concentrate and take away how to use that LIFO reserve and also the LIFO liquidation.